let's start with basically what you're looking for. I know that there are 4 pillars in the investment process because I got some slide docs ahead of time and I had a look through basically the process that you're following. And I know from the previous conversation with Stuart that we talk about, excluding companies or including companies into the universe based on ethical considerations. But I know that there are these 4 pillars or the investment merits that you're weighting and you're judging these companies against. So I'm hoping you can step us through those one at a time, and feel free to use examples as we go through, because I think this is kind of like the meat in the sandwich of the investment strategy. I'm keen to drill into this.
Yeah, that's great. Let me try to give you some examples of each of those, and clearly, there's no sort of secret sauce in business model, balance sheet, fundamental valuation, expected return. These are core tools that you'll find at any fund manager, but I think really it's all to do with how these are applied, as part of a process. And so let me give you some things that we like. Just almost a laundry list of things that we like when we're looking at business models, and we've learned these through time. And one of the very obvious ones is we like repeatability of earnings, right, or what we call recurring earnings. So take a business. We do a lot of work in the healthcare sector. Take a business like Cochlear. Is that a recurring revenue stream? Well, it has been through time, but a lot of that is coming from individual cochlear implants and new sales, rather than what they call the services part of their business. So its earnings are actually dominated by the sale of implants. Now, if I compare that to Fisher & Paykel Healthcare, Fisher & Paykel Healthcare have a much bigger percentage of revenue that's coming from consumables. So I would argue I think they're both fantastic companies, but in some respects, Fisher & Paykel has a slightly stronger business model than Cochlear from the point of view of repeatability. And then, you can sort of take that analogy to other sectors where you might look at a contracting company that has one big contract that expires in 3 years. And, I would say there's nothing really repeatable about that business, and that they're the sort of businesses that we don't like. A second one in terms of business models is, we think a lot about scalability, and this often has to do with, a level of IP that a company has, or the ability to get economies of scale. If you looked at one of the big supermarkets, or in a technology company, the ability to go offshore. So, an industry where I guess we don't think has many economies of scale would be, for example, the aged care sector. We saw the aged care sector list on the ASX with great promise. A lot of acquisitions and sort of roll-ups in that space, and it wasn't really clear that 1 + 1 made more than 2. And I think that's because, really they're a services style business. And that's something that, I guess in our process, we do tend to privilege product-oriented companies, because we think product-oriented companies scale better than services. And so, a company like Fisher & Paykel or Cochlear, I mentioned before, great product-oriented companies with global edges that have scaled really nicely. That brings me to the third thing. We like companies with high gross margins. We've certainly found that businesses with low gross margins, they can struggle. I mean, it's certainly not the case for every company. You can be a big large scale retailer with low gross margins and do very well. But something like the healthcare space, we certainly like to see a company with high gross margins. And then the final one is capital intensity. So we're very aware of how much capital companies having to reinvest in their business, where they are in that sort of capital journey, and are we getting an appropriate return on that capital? And
Can I just ask one question there, Mike?
Yeah.
Just on capital intensity, how would you measure that, or even just get an insight into that?
Look, you could, for example, you could simply look at return on assets through time, and you certainly can. You find you can see a company that's growing its earnings, but actually its return on assets is decreasing because it's deploying funds in a suboptimal way. I'll give you a counter example. A company we've invested in, the High Conviction Fund, is Downer. More recently, and they used to be a mining contractor, and that wasn't something that really that they were excluded from our universe. Under our ethics charter, they're out of that business, so they're within our ethical universe. But what we really like about this business is that the mining contractor business was also very capital intensive, and so the capital requirements in that business have fallen. And so one of the other ways of measuring that, I guess, is just comparing a company's what I would call sustainable capex. So a sort of a through the cycle normalized capital expenditure number against what they're recording as depreciation in their accounts. And, in that case, they're recording capex below their depreciation. So we think they're on the right side of that equation.
How about the second thing then, which is the balance sheet What are you in particularly studying here to get this, through to like, let's do further research on this?
Yeah, sure. Look, and there's obviously a whole range of things. I mean, this thing about capital intensity obviously plays into balance sheet, right? Because a company that has to spend a lot of capital to sort of replenish itself, that's going to eat into the balance sheet through time. And so I think probably the most important thing about looking at the balance sheet is not looking at it in isolation. It's also looking at it in the context of the particular business and the particular industry. And so, I guess a very obvious example is obviously companies with lower degree of variability in their earnings can sustain a higher gearing. So something like an airport is a good example, although even COVID proved that wasn't necessarily the case. And, there was a situation where those companies were going to need additional capital. So we look at the at the business fundamentals, how cyclical a business is, I guess. If you're in a cyclical business and you're at the bottom of the cycle and the business is highly geared, well, maybe that's okay if you have a strong degree of confidence that actually earnings are going to go up and we really are at bottom of cycle levels. But, on all things being equal, we do, like most people, prefer companies that are more conservatively geared. We certainly don't like companies gearing up against what we would call sort of non-recurring revenue streams. We think that's a recipe for disaster. And you also got to look at the phasing of debt, and I think there'll be a lot of focus on that. And now we're talking about interest rates going up. People will want to know very shortly how companies are hedging that debt, and also what sort of pricing power do they have in their core business. Because if you've got a lot of debt and your cost of interest is going up, then what you're going to need to do is be able to put your prices up. And if you can't, then you've got a problem. So there's some of the things we look at. Does the company own its property or not? Has the company taken very conservative provisions? If it was a financial company, we also look at things like, apart from the sort of typical ratios like net debt to EBITDA, for a retailer, we might look at fixed charges coverage ratios, because those companies are often very reliant on operating leases in the situation where they don't own the property. So they're just some examples. I think one of the things that were found during COVID with quite a lot of capital raising activity. And so I've been giving you, I'll just follow through on the Cochlear example. They raised a lot of capital because they thought their business was initially under pressure. The business recovered more quickly than they expected. And actually now they've got surplus capital, net cash on the balance sheet. And, we certainly can find companies at the moment, and we certainly always like them when we do that, very high quality business models like Cochlear, in a sort of net cash position, and we think that's quite a strong position.